Hello, this is Kevin Liniak, Fixed Income Portfolio Manager for Parametric. Today is Wednesday, May 15th, CPI Day. So, in the last 2 weeks, we've had new inflation and payrolls data, as well as the FOMC meeting, where we've seen a little bit of a narrative change that has altered the path of interest rates. So, in today's 5 and 5, I will break down CPI, payrolls, Fed, and our rates outlook in 5 slides that will take less than 5 minutes to go over. So, let's get after it. First, CPI, the Consumer Price Index, rose 0.3% in April, slightly less than forecast, while core CPI, ex food and energy, came in line with median estimates once again at 0.3%. So I would call this a slight moderation in the inflation data. This report was taken positively from stock and bond markets. It was the first time this year that we did not see CPI inflation data surprise to the upside. Now, one report is unlikely to inspire a significant amount of confidence from the Fed either way. And also the headline CPI and core CPI, they annualize out to 3.4 and 3.6%. So that is well above the Fed's 2% target. But at least we are starting to see us slowly moving in the right direction again on the inflation data and moving back down from higher inflation to slightly lower. You heard Fed Chair Powell yesterday. He reiterated that the Fed needed to be patient and let restrictive policy do the work. So that brings us to the path of rate cuts. Since the Powell pivot in the fourth quarter, we've seen a dramatic repricing of interest rates. And that's what we have here in the next slide. In the beginning of the year, the market front ran Powell's pivot, and they started to price in 6 to 7 rate cuts for 2024. Now, as CPI data and payrolls data came in much stronger in the first quarter, the market started to price out some of those rate cuts. So now we're only seeing around 2 rate cuts priced into the market, and I think probably around the September FOMC date as well as the December date. Now, as the year wears on, the calendar around the elections gets more difficult. The Fed meets on November 7th. Are they going to move rates 2 days after election where we may not know who the president is at that time? So, I think while the Fed is not partisan, I do believe that they are political. And what I mean by that is I think the Fed will not want to politicize the institution, and they certainly want to be viewed as moving interest rate election kind of either way. So I think we'll have to see how this data starts to show up weaker in a series of months here going forward to get the Fed to start to move and start cutting rates. So right now, for the next meeting here, I think we're not going to see anything out of the Fed but a dot plot, but the market is starting to price in 2 rate cuts for the year. And that brings us to the next slide, the move in rates year to date. And this is looking at the 10-year Treasury yield. Both the 10-year and the 2-year note are about 50 basis points higher on the year as these rate cuts that we just discussed got priced out of the market. Now, we are 25 basis points off the year-to-date high in yields that we just saw a few weeks ago. And we're well below the 5% level that we saw in 10-year notes last year. Now, as I said a few weeks ago, I think it would be very difficult to eclipse the 5% that we had last year this year. But we would need to see at least 2 things happen in my view. First, Janet Yellen at Treasury would have to issue more longer-term debt in the quarterly refunding. And in the refunding announcement that we got 2 weeks ago, we did not get that. In fact, she came in and said the next 2 quarterly refundings would cap at the current rates. So a lot of this Treasury funding, these big deficits that we've been discussing for a long time here, a lot of this is getting funded in the bill market and in the front end of the yield curve. Number 2, more importantly, the Fed would have to repivot and leave the door open for more of a chance of potential more rate hikes this year. And Powell did not do that at the recent FOMC meeting in May. In fact, he pushed back multiple times on leaving the door open to rate hikes. With no more rate hikes on the table, we're either on hold until the data gets softer, and if the data gets softer, then I think potentially you could see a couple rate cuts. At least the market start having that discussion. With Powell having the markets back, we've started to see asset allocators step back into the bond market. And at these higher yields, especially the people who missed the rally last year, we've seen a lot of inflows into the market over the last couple of weeks at these new higher yields. And this brings me to the next slide, the Citi Economic Surprise Index, where we just started to see this tick lower and in a negative level. What does this mean? It means that we're starting to see some data come in less than estimates in the street. So if we look at April payrolls, they came in lighter at 170,000 versus 240,000. This is one of the first times we've seen weaker payrolls data come in weaker than estimates. And if you look at recent jolts or quit rates, it suggests some softening in the labor market. We just saw the weekly jobless claims print the highest level that we've seen in 8 months. So starting to see a few cracks show up. A week or a month in data does not make a trend, but the bond market is starting to pay attention. If you'd like some information to discuss parametric fixed income solutions or any portfolio reviews, please reach out to your individuals at the Eaton Vance Distribution team, and good luck in the bond market. We look forward to hearing from you.